Hi all and welcome to TCM Education. This is our third video in a row with the same subject, trading with a 1% risk on the position. Again, just to go through a quick recap, what's the idea? You buy a position in a stock. Doesn't matter if the stock is $10 or $100. The position is $20,000 or $5,000 or $150,000 according to your risk tolerance, because you will need to risk up to 1%. So if the position will be $100,000, your maximum risk, which may or may not happen, but if it occurs, it means $1,000. So maybe you want to scale back and take only a $40,000 position. In this case, the risk is only $400 or a $20,000 position. In this case, the risk is only $200. Bottom line, it's a scalable, very easy to scale into and out strategy, which puts you in a position where you know what is the risk on the trade before you make the trade, because that's your bottom line. That's a strategy. No more than 1% risk, no matter what. Okay, so you may agree, you may not agree, you may implement, you may not implement. That's the strategy that we're trying to show and show how effective it is and how you can use it to your benefit, assuming that you are a day trader. Because if you're not a day trader, you cannot trade with a 1% risk over reward, which can be, I don't know, maybe 100%. But day trading overnight with a 1% of risk is, no, it's not. You can do it if you're lucky. It can happen, but overnight moves will probably kill most of the those type of ideas. And again, the idea here is to take the best performers. Here I have a list of stocks. All of them traded more than 5 million shares. All of them have a daily range of more than 5%. We talked about it extensively, and all of them are about $15. So let's go to number 3, and we analyzed today two stocks. SRRK, that's Scholar Rock. Never heard about this company ever. Okay, price $35. Oscar Health price, let's round things up, $18.50. So what does it mean, $18.50? The risk is 18 and 19 cents. Let's say 20 cents. That's it. That's the 1% of risk. You cannot take a trade with more than 1% of risk. In this Oscar, the $36 implies that 1% is 35 cents of risk. And if you want to trade CRCL, $200, 1% is $2 of risk. Good luck trading it with $2 of risk, but let's say it's possible. Okay, so let's move to the third idea. Let's go down the list. Okay, down the list, a stock that's still up more than 5%, and the range is, let's see the range percentage. Keep in mind, guys, this is a number that's super important to us. Let me highlight it. Range percentage, super important. Why? Because we want stocks that are developing a range between the highs and the low that is as big as possible. Obviously 35% is crazy, but 10% to 15% is perfectly fine. You know what, let's go with Solar Edge. Why? Because yesterday it had a terrible day. It has exactly 10% of range, has amazing volumes, 13 million shares. I didn't look at the chart, I'm just guessing with you about the outcome. Let's see how we can trade it with 1% of risk, and 1% of risk being that the stock price is $17 is 17 cents. So we cannot enter a trade here when the risk is more than 17 cents, or according to the chart, which is obviously what we're doing all the time. Okay, so this is it, Solar Edge. Okay, so this is the chart of Solar Edge. Oh, what an ugly chart. Okay, so not very promising. Let's see if we cannot do it, so okay. It's not like we can do it every time. It's not, I wish it was. So what's happening with SolarEdge? On the prior day, let's see the YTD. You can see the huge gap. That's on the Senate, basically telling solar and clean energy and wind energy and all type of other stocks in this sector that they're not going to fit any more subsidies into this sector. So that's a bad thing. The stock dropped 35%, then recovered some, but that's pretty much it. Now let's go and see what happened intraday. We're talking about the 3-minute, hold on a second guys, the 3-minute chart. 3-minute, that's it. Reset view. Okay, so this is the chart of June 18. You can see the gap up, small gap up, then a run higher, a pullback. Nothing here fits. It's so aggressive. Let's go with the breakout over 17. Can we try the breakout over 17, which is this level, with a 10-cent stop loss? Obviously not. Stop loss here looks like more like 40 cents, if not more than that. So that's a no-no on the breakout here. Okay, then the stock continues higher, moves sideways, then creates another, let's call it potential reversal trade here at 1740, but the channel is this is a 2% channel, not a 1% channel, and then the stock takes a dive. Now where you can, if at all, trade it with a 1% stop loss, it's only at this level. Sorry, but that's it. Let's call it 1650. You know what? Let's be more accurate because this is important. 1640, 1650. Yeah, there is an option. Again, very tough to observe. If you observe it, you can do it. This channel where the stock basically trades a couple of cents under 1650 and moves sideways, tests this level 3 or 4 times. 1, 2, 3, 4, 4 times. So if you're able to trade it and you use the stop loss here at 1640, this is the level of support where the stop loss, under which the stop loss should be. So where is the enter? 1650. That's 10 cents of risk, and it reaches 17 and drops, and overall not a very encouraging pattern. I mean, it can be traded, but needs a lot of experience. You get 4 to 1. I don't want to say that this is a trade that I will advise people to search for. Why? Because it's an effort, and while you're making this effort to trade this stock for 30 or 40 cents, and maybe you can take a 20-cent winner out of it. I don't know. Let's say you sell it at the close. Okay, so you take a 40-cent winner during the same time, which is now a lot of time, like 3 hours. Maybe you can trade other stocks. So I have to say that SEDG, as much as I want to be supportive of the stock, does not fill the bill. I mean, you can trade it, but it's very hard to pinpoint the entry. Then you get nothing in return, and then it moves sideways a lot of time. And again, in another given day, this strategy can work. I mean, the same strategy can work tomorrow, which is a Friday, and deliver a 10 to 1 risk reward. So that's anybody that trades stocks knows that anything that we are looking and doing applies to one specific scenario, which may repeat itself in other stocks, but it's not like it may not repeat itself with SEDG ever. We may see it with other stocks, but this scenario may not repeat ever with this SEDG. Okay, so we have 5 more minutes. Let's go to another option trade, and actually I want to show you. I want to show it to you because I saw it. It in shock. Take a look at this SYMB, sorry, SYM, and I was in shock when I saw it. We have only 4.5 minutes to go over, so I will go over it fast. So what happens with this stock? Symbotic, probably better stock, but I'm not sure. First of all, it doesn't open with a gap. So if the stock does not open with a gap, how do we know that it even exists? And the answer, we don't know that this stock exists. We don't know. Why? Because it's not on everybody's watch list. But then something happens. Okay, you look at this channel movement, which is unbelievable. Now at one point the stock reaches 5% in the money, 10% in the money, 15% in the money. So at one point you observe it. Let's say we observe it at 34, not at 33, but at 34 here. Can we trade it with a 1% risk at 34? The answer is yes. Okay, so let's say we buy it at 34. It looks very extended, but we take a 35-cent stop loss to this level here, and it works. Okay, now what is the target on the trade? 2 to 1, 3 to 1, 5 to 1, or 10 to 1. Obviously the stock delivers more than if the risk is 35 cents, 10 to 1 is $3.50, and this one goes at $1.4 plus. Okay, so how do you react to that? And at one point, being that the stock looks very extended at every move, I mean, anywhere you look at the chart, the stock looks hyperextended, and at one point, after breaking 38, I guess, the sellers decided, okay, that's enough, and the stock dropped like $2, which is, let's call it 6-7%. Bottom line, okay, those type of opportunities are moving around us as day traders all the time, okay, all the time. Now, out of the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 20, 25 stocks that I'm seeing here or showed you, okay, this is a list of, hold on a second. The overall list is 39, but you see less than that because I can flip the list and we will see the losing stocks. But again, you can see that this is a very, very precise list of stocks that traded more than 5 million shares, that have a specific requirement of above 5% on the daily intraday range, and they are above $15. And we're looking at stocks that are up 30% and 10%. We're not looking at stocks that are up 1%, which is most of the 90% of the market. If the market was up, actually the market yesterday was flat. 90% of the market closed flat. I don't want to say that I can guarantee it's 90 or 87, but that's the majority. Those are the outstanding stocks. That's why we are looking at them. Okay, guys. So again, you want to get involved with this strategy: 1 to 5, 1 to 10, 1 to 3. You may lose 3 in a row. You lose 3%. Worst case scenario, you are a terrible trader. You lose 5 in a row. At one point, you're going to get a 10% winner, maybe a 15% winner. And I'm talking about day trading. I'm not talking about swing trading or investing. Okay, why? Because you're looking at those stocks. Okay, the stocks that are going to do or deliver. Hope it was clear enough and illuminating enough. Thanks for being here with this third video on this subject. Please share this video with your friends, especially those who day trade. And we'll see you in our next video. Take into account, if you want to sign up for the seminar this coming weekend, please do.